All right, well, welcome again, everyone, to New Energy Conversations with Early Career Energy Researchers. My name is Megan, and I'm the Manager of Academic Initiatives at the Irving Institute for Energy and Society at Dartmouth College. And I'm really excited to welcome everyone here today for the second talk of our fall season of the series. Now, the New Energy series began during the pandemic as a way for up-and-coming energy and climate scholars to stay connected and share their work. And since then, we've had almost 50 speakers, and the series has sparked an event, the New Energy Summer Summit, which just completed its second year. And this brings together a highly multidisciplinary cohort of early career energy and climate researchers to the Dartmouth campus to forge new connections and potential collaborations. So now, before we begin, just a note that after the talk today, we will have an opportunity for discussion. So please feel free to enter your questions for our speaker using the Q&A icon at the bottom of your Zoom screen. All right, so with that, let's get started. And I'll kick us off by introducing our moderator for this talk, Claire Kaditham. So she is a Revers Center for Energy, Sustainability, and Innovation Fellow at the Tuck School of Business. And prior to Tuck, Claire worked for 5 years as an engineer in conventional oil and gas, as well as oil sands mining and upgrading. And her work focused on decarbonization and technology development, carbon accounting, and environmental performance. She came to Tuck to explore her interest in enabling an equitable energy transition through the deployment of technologies and infrastructure in frontier markets. At Tuck, Claire serves as director at Tuck Social Venture Fund, director of Tuck Student Initiative for Decarbonization, and is a co-chair of Tuck Sustains. Claire interned this summer at Bain & Company, where she will be returning post-Tuck. Claire holds a Bachelor of Science in Biochemistry and Mathematics from McGill University and a Master's of Science in Chemical and Petroleum Engineering. All right, welcome, Claire. I'm going to turn it over to you to introduce our speaker for today.
Lovely. Thank you so much, Megan. And thank you everyone for joining us today. It is my great pleasure to introduce our speaker, Chell Lyons. Chell is a Sir Roland Wilson Scholar in the Reed Department of the Crawford School of Public Policy. Her doctoral research examines the role of public financial institutions which leverage private finance in the transition to net zero emissions, with a particular focus on public green banks. She is interested in the intersection between climate finance, geoeconomics, and climate justice. She is currently on leave from the Department of Climate Change, Energy, Environment, and Water. She has previously worked in a number of roles on international climate change negotiations, emissions projections, carbon price development, and climate change science. Most recently, she was seconded to the ANU as the inaugural J.W. Land Research Fellow on the Grand Challenge on Zero Carbon Energy in the Asia Pacific. In 2017, she was awarded an Emerging Leader in the EU-Australia Leadership Dialogue. In 2015, she was part of the winning team in the Cross-Cultural Business Accelerator Camp and was invited to participate in the Cicero On Incubator. She is currently a part-time climate change research fellow in the Lowy Institute's Indo-Pacific Development Center. Her research centers around climate finance, climate justice, and climate change policy evaluation. Chell has a master's in public policy and an honors degree in media and communications, both from the University of New South Wales. Without further ado, I'll now turn it over to Chell to start our talk.
Well, thank you so much for that introduction, Claire. And I'm absolutely delighted to be here speaking with everybody today. I'm just going to share my screen and get started. As Claire mentioned, I have a slightly different background to most of the speakers in this series. I'm actually a policy practitioner, and I've spent the last 15 years working for the Australian government on domestic and international climate change policy. And so the genesis for this research was that the Australian government every year, they send a few people from the Australian Public Service off to go research topics of national significance and then come back to the public service and sort of diffuse those sort of learnings throughout the sector. And so I had worked on climate change for a long time, and I was really interested in looking a bit more at green banks because Australia has one of the longest running and the world's largest national green bank. which was a complementary measure when we introduced our carbon pricing mechanism. And so this was the impetus for me to go and to research green banks more broadly, which is what I'm going to be talking to you about today. So it will be a fairly standard kind of presentation. This is the first paper from my PhD, which is currently under review. And I'll go through sort of the background, the research questions, my literature kind of influences and review and hypotheses, methods, results, and conclusions. And please do feel free to pop any questions in the chat. I'm really looking forward to the discussion. So the first sort of thing that I do with any sort of research undertaking is to sort of ask myself, well, what is the problem? What are we looking at here? And the problem in this instance is a very familiar one. It's that decarbonizing the global economy requires a really significant increase in funding for low carbon infrastructure. And I think this recent chart from the IPCC's sixth assessment report really demonstrates this quite beautifully in a very sort of visual way. Looking at this chart, which breaks down the required level of mitigation investment to limit warming to 2 degrees Celsius or lower, you look at where we are, which is in the sort of blue bars, versus where we actually need to be, in the sort of grey bars. And doesn't matter if you're looking at by sector, by the type of economy, or by region, there is absolutely nowhere that we are on track at present. And so it's really imperative that we scale up current levels of investment to meet the temperature goals of the Paris Agreement. And it's worth noting too that private sector funding shortfalls are particularly acute. And so this was part of the reason that I became interested in green banks. And I should say that green banks are actually terribly named because they're not banks at all. They're actually state infrastructure funds mostly. So they don't sort of seek funding or capital markets in the way that traditional kind of banks like MBDs do. But there are a number of green banks that have emerged sort of around the world over the past sort of 10 years, I would say. And this chart from State of Green Bank report that Rocky Mountain Institute put out a few years ago, I think is a really nice kind of visual map. So Australia was one of the early sort of national green banks. It was founded in 2012 as part of our carbon pricing mechanism, as I mentioned. The UK had a green investment bank that was founded in the same year. That was actually sold in 2017 by the Conservative government. And actually, it was a private Australian banking corporation that bought it because they had seen the value from the CEFC's investments and thought that the UK bank was a good investment. Now, there are numerous subnational green banks around the US. So the New York Green Bank, founded in 2014, is the largest. It had a $1 billion capitalization. Then there's also the Montgomery County Green Bank, which was founded in 2015, that was the first sort of county level bank. And I must say, I was hoping slightly when I started doing this research that there might be funding for a national green bank that would get up whilst I was undertaking this project. And so I was delighted to see that when the Inflation Reduction Act passed last year, that there was $27 billion in funding for green bank measures. And the EPA is currently holding funding rounds to sort of disperse some of that funding at present. So just on. So what are green banks? They are, as I said, state sort of infrastructure funds that are focused on low carbon, climate resilient investments. And they come in and make investments right at the end of the innovation cycle, sort of in the commercialization phase. So they are not sort of generally making investments in that earlier sort of R&D, sort of emerging technology phase of the innovation cycle. What green banks do is that they often take technologies that are commercialized but haven't been deployed in a particular jurisdiction, and they'll deploy that technology for the first time in that space. They will reconfigure existing technologies in new ways. Or what they primarily do is that they structure finance in innovative ways in order to deploy renewable and clean energy technologies. So my research questions, I think I just slipped. My research questions for this paper are really based around understanding green banks as hybrid organizations. So I was interested to know, how does hybridity manifest in green banks, and how do green banks create value through their investments? And this was really, these research questions were drawn from the public management and literature that looks at hybridity, and I'll move on to that now. So the conceptual framing, there's very limited literature that exists on green banks. So by far the most cited study was one that came out of ETH Zurich in 2018. And that study actually looked at 3 different organisations. So the CEFC, the UK Green Investment Bank, and KfW, and which is not a green investment bank, but they looked at how these organisations were addressing barriers to finance in the net zero transition. And they found that these 3 state investment banks, which is how they characterise them, address barriers to finance by undertaking a range of roles, including capital provision, de-risking, education, signalling, and first or early mover roles. And so our paper seeks to build on this research to examine green banks as hybrid organisations at different governance levels. And this paper will be the first, to our knowledge, examination of green banks at the national and the subnational level. We've got 4 case studies: Australia's Clean Energy Finance Corporation, the New Zealand Green Investment Finance, which is New Zealand's national green bank, the New York's Green Bank, the largest state-based green bank in the US, and then the Montgomery County Green Bank, the first county green bank in the world. And so we particularly draw on the work of Vakuri and Johansson, who conceptualize hybridity in 2 ways, as either organizational dimensions or through their approaches to value creation. And so what we're seeking to do is to use our case studies of green banks to provide some empirical data on dynamic value creation. And I'm very interested in exploring how value accrues at different levels. And this is one of the first studies to do that. And we also look at how value has been created at different points in the policy cycle for different actors. So I had fairly strong hypotheses coming into this paper, not just because of the expert interviews that I had done, but also my previous work as a public servant. I'd actually done a bit of work on the Clean Energy Finance Corporation when I was working on the G20 Climate and Sustainability Working Group. And when Argentina was president back in about 2018, they had asked everybody in the G20 to bring some examples of best practice. And Australia's example was looking at the Clean Energy Finance Corporation and some of their work around low-income energy efficient housing. The CEFC had made some investments in low-income energy efficient housing apartment blocks, and those investments had catalyzed significant further investment in energy, the commercial energy efficient building sector in Australia. And so I had a strong suspicion that there was going to be significant co-benefits to some green bank investments, because I knew that those low-income energy efficiency housing investments had actually resulted in significant reductions to the tenants living in those buildings. And they were in the magnitude of about a $500 cost reduction for the electricity bills for those tenants, which in some cases meant that they were moving from being below the poverty line to being above it. And so I was really interested to explore this value creation. And so I had also had a strong sort of sense that perhaps not all of the value of those investments and the benefits to the tenants were being captured. And so I wanted to sort of explore that in this paper. So as I mentioned, the scope of this study considers 4 green banks. 2 that are operating at the national level, so Australia's Green Bank, the CEFC, and New Zealand's Green Bank, NZGIF. and then 2 subnational in the US, the New York Green Bank and the Montgomery County Green Bank. And so I conducted a range of expert interviews with current and former Green Bank staff, clients, co-financiers, public servants, and ministerial staff. And I was very lucky as a public servant. I've worked in the climate change space long enough to have known people in the Clean Energy Finance Corporation that I could reach out to. And they are part of an international Green Bank network that has annual conferences. And so I think I interviewed 5 senior managers at the CEFC who had been there since the inception of the bank, and in some cases had worked for the precursor to the CEFC, an entity called Low Carbon Australia. So they had very deep institutional expertise. And thankfully, one of them was also the coordinator for the International Green Bank Network. So he was able to put me in touch with colleagues that he knew from the New York Green Bank. And I reached out to Montgomery County Green Bank through LinkedIn, and New Zealand, Green Investment Finance, I was also referred to from the CEFC. So it was, excellent to be able to sort of speak to interviewees of that caliber. So I spoke to several CEOs, so 2 former CEOs, one of the CEFC and one former CEO of the UK Green Investment Bank, he was the CEFC before it was privatised. I spoke to the CEO of the New Zealand Green Investment Bank and to the now CEO of the Montgomery County Green Bank. So it was very fortunate to have access to senior decision makers, but also the investors who are making a lot of the deals. And so then I also, with my co-author, Dr. Levy White, we undertook some document and interview sort of theme analysis. Our interviews were categorized according to 7 thematic nodes, which was sort of based around different sort of governance, evaluation, investment metrics that related to hybridity and to public value. So this chart, I think, just provides a good kind of breakdown of some of the key statistics of each of the 4 banks. And you can see that they actually, are very, very different organizations in terms of their scale, but also their investment focus. So the CEFC has a clear, originally had a mandate to invest, to accelerate investment in clean energy technologies. That's actually been broadened in the past year so that its mandate now includes all activities to accelerate Australia's path to net zero emissions. And that change was put through following a change of government in Australia, where the government increased our 2030 target. And so it had initial capitalisation of 10 billion. But green banks actually leverage in significant private sector finance. So they don't fund any transactions entirely by themselves. They only fund transactions that would otherwise not be funded by commercial partners, but they leverage that commercial finance in to their transactions. So the CEFC has leveraged a total of $37 billion in the time that it's been operating, which is about 10 years. And so for every dollar it's spent, it's leveraged $2.40 on average from the private sector. And it's had a number of its loans repaid. And so it's actually recycling through that $10 billion capital into different loans. And you can see the New York Green Bank is sort of similar. It's had $1 billion, $1 billion capitalization, but its leverage ratio is slightly higher at US $2.65. New Zealand, you can see its ratio, leverage ratio is slightly lower. It's at $1.27. And that's because New Zealand has a fairly unique emissions profile. So they have a very large agricultural sector. They have a lot of hydroelectricity, so a fairly decarbonised electricity sector. But they do have a lot of their emissions reductions in those harder to decarbonise sectors like agriculture and a bit of industry. And so it's not surprising that they have a lower leverage ratio, because it's actually harder for them to create those bankable kind of projects. They're further along the net zero kind of investment transition. And you can see that there's a real variation in terms of emissions reductions across the organizations because of their different size. And at Montgomery County, is much smaller as a county level green bank, and it doesn't have sort of all of the stringent public reporting requirements that the other entities do. And so for some of those sort of metrics, they're not actually available. And I should note that the emissions reductions are not comparable across organizations because they're all calculated slightly differently. So when we investigated these 4 dimensions of organizational governance that Vickery and Johansson outline in their model, the first is mixed ownership. And so green banks definitely do exhibit characteristics of mixed ownership. So they're all, publicly owned organizations, or they're set up by, national or subnational governments, but they exhibit a very high degree of independence. And there's, I think, a really nice quote here from Steve Morrell, the CEO of Montgomery County Green Bank, where he sort of notes how important it is that the Green Bank has that independence from the county in order to make its investment decisions, and how that's been key to their success. And that is something that's also is reflected to me from one of the senior managers at the CEFC that noted that being able to pursue investments in a commercial manner without interference from any groups or parties that might have vested interests is absolutely critical to the work that they do. So they, while they have been capitalized by governments, they actually operate in a kind of a private kind of commercial manner. So the second characteristic that Vickery and Johansson sort of talk about is goal incongruence and competition as being a feature of hybrids. And this definitely came through very, very strongly in our interviews. So again, another great quote from Steve Morrell here about, that tension that exists, and it existed in all 4 of the green banks that we spoke to, between investing in projects that have significant emissions reductions and very high metrics versus investing in projects where you can catalyze significant changes in market segments. And so, both of those metrics are important, but you need to strike the right balance. And something that really came through in the interviews was that there's a very high degree of expertise amongst the Green Bank staff. So many of them had, almost, had over a decade, I would say, often of experience, which, in the climate kind of world, if you're focusing purely on green transactions, it's a long time. And so I think the expertise of Green Bank staff had definitely been one of their sort of greatest strengths. That goal incongruence, I think, is going to be something that probably becomes an area of increasing tension as we start to accelerate through the net zero transition, and there's more competition for these experienced kind of managers. It's going to be sort of very important for those organizational structures to be facilitating significant sort of training and upskilling of staff that are starting to work in them, as people, a number of the banks said to me they're already having staff that are starting to be, headhunted by commercial banks who now see the value in these transactions and are trying to quickly, increase the amount of staff that they have there. And that will be a particular challenge, I think, for developing countries who are looking to institute green banks and to have expert staff that they can retain over the long term to kind of build those institutions. So the third feature that Vickery and Johansson sort of point to in their organizational kind of dimensions of hybridity are a multiplicity of funding arrangements. And I mean, this manifests very clearly in green banks in 2 ways. And so the first is through the different types of funding sources. And for the 4 green banks that we profiled, there was a real range of sources. So the CEFC and New Zealand Green Investment Finance were funded largely through government appropriations, but the tax revenue was an important source for New York Green Bank, which gets some revenue from the Regional Greenhouse Gas Initiative. the Montgomery County actually has a fuel surcharge on fossil fuels, which funds them. And it's actually a really interesting model because that surcharge means that, as fossil fuel use declines in the county, the revenue of the bank will also decline in a corresponding way. And so it's a really kind of, interesting arrangement to see, will that need for the bank decrease in, the linear fashion, or the same fashion as that fossil fuel kind of revenue decrease. All the banks, make concessional loans, and so they get interest on their loans, and they have that finance cycling through. So profits, are a source of income for them as well. They're all sustainable. And that, is one of the features of green banks and their political economy. I think that makes them so attractive to governments all around the world at the moment, that you can capitalize them for a relatively small amount. They then leverage in all of this private sector money, but they're not costing the government anything. They're actually making money for the governments. So I think they're a very powerful institutional tool in this transition to net zero emissions. And then private capital raises was another sort of source. So New York Green Bank had a significant private capital raise, and the CEFC has refinanced lots of their deals as well. So yeah. And then the second sort of area where there's a sort of a multiplicity of funding arrangements for green banks is through their funding instruments. And, green banks are primarily using concessional debt because they are an equity, because they are at that sort of later end of the investment sort of spectrum. It's, I would say more debt than equity. But then there's a range of other financial instruments like subordinated debt, where the bank sort of is the senior debt partner and will take on the risk before the private sector financiers, and that just gives those private sector investors the confidence to make the investment at times. I had one client of the CEFC say to me, if I go into my risk committee in my banking institution and tell them that the CEFC has done their due diligence on this deal and they're happy to be the senior debt partner, it just, everyone breathes a sigh of relief, because they know that the CEFC has very stringent sort of risk management and approval processes. They're more stringent than commercial entities because of their sort of public financial management requirements. And so that, carries a lot of weight. Warehousing and aggregating has also been important for a couple of the larger green banks, where they sort of work with financial partners to aggregate a whole lot of smaller scale products into larger deals. And so that's sort of taken the form of home loans at a discounted rate for energy efficient homes, or slightly discounted interest rate for people purchasing electric vehicles, that kind of thing. And then, you've got other instruments like green bonds as well that have also been deployed a little bit. And so actually, I've just seen a question in the chat from Pradeep about, is the financing mechanism by green banks an example of blended financing? So my understanding with blended finance is that it's largely used to discuss finance that's deployed sort of multilaterally, so for developing countries, whereas green banks are generally national level instruments, or have been to date, national level instruments that have been deployed by governments. So there is definitely that blending of public and private finance in the same sort of way, but it's just at a slightly different governance level. But thank you for that question, Pradeep, because that is very relevant to what we're talking about. So then the final area of organizational kind of dimensions of hybridity is public and private forms of control. And so there were a lot of instances where public forms of control were evident over green banks in terms of their reporting requirements. So the Australia, the New Zealand and New York Green Bank all have to report publicly their annual reports. They often have sort of particular project reports. There's statutory reporting to Parliament for Australia and New Zealand. There's a number of different things. And they're often, those public kind of reporting requirements are generally around the financial kind of performance of the banks. But then it was interesting, within all of the banks, I observed in the interviews a very strong tendency towards having a private sector kind of commercial environment, sort of similar to a commercial bank. And so there was a really good quote from former CEO of the CEFC, Oliver Yates, who actually came from the commercial banking sector, like most of the green bankers I spoke to around the world. And, he said that when he set it up, he was really looking to set it up like a private organization, because he wanted people in commercial banks to walk in and feel comfortable. And so he was, constantly kind of pushing back gently against the bureaucrats within the public service that he was dealing with in Australia, who, wanted the term sheets that he developed to adhere to public service sort of templates, which was not how the private sector kind of worked. And so there's this real kind of tension, I think, between those two cultures. But in all of the green banks that I sort of spoke to, it was very obvious that commercial sort of institutional influence had prevailed. The private sector influence had prevailed over the public kind of culture. So, it was very interesting to me as a public servant, because the green bankers just thought about things in a completely different way. And, to circle back to the example I gave at the start of the talk about the low income energy efficient housing, I had it when I started talking to a couple of the Australian bankers about that. And I sort of said, oh, that's amazing about the cost savings for the tenants. What a life-changing kind of thing for them. And one of them sort of looked at me point blank and he said, oh, that's really true, Chell. And, it's definitely something that we're always thinking about. He's like, but it's not what drives us. We made that investment in those housing blocks because they're very large apartment blocks. And we wanted to show that you could build energy efficient 6-star houses for a very small premium, compared to what the commercial operators were building their apartment blocks for. And so we would catalyze all of them building those apartment blocks because they knew that they'd be able to make a significant profit and to be able to sell energy efficient homes for, say, 50% when it only costs 10% more to build them. And I think, it's a very interesting kind of difference in approach between public servants and bankers. And so this leads me perfectly into the next sort of research question, which we had, which was around the value creation and capture of green banks. And so we did talk to all of our interviewees about and ask them about, well, where do you see green banks creating value? And you'll see that knowledge spillovers was a definite area that was identified by all the different kind of cohorts that we spoke to. And that was encouraging to us because that was also one of the key areas that had been identified in the Geddes paper on green banks that had previously been done. But then there was also a lot of respondents who saw social equity benefits and then enhanced energy security. And then there was a range of other forms of public value creation, which included things like food security, benefits for First Nations peoples, and enhanced enhanced water security as well. But I think what's really interesting about this chart is that the Green Bank staff saw the most benefits. And, I think that's an interesting area to explore in further depth as to whether there's value, the perceived value that's being created, but that other cohorts like public servants and project proponents, they just don't realize that it's happening. Or is it, that perhaps they don't perceive it as actually, is it just that they're not seeing it, or is it that it's actually not happening? I think it would be interesting to delve a little bit more deeply into that in further research. And then this chart actually was an attempt to use that example around low income energy efficient housing to actually look at value creation at different levels. And this is something there's been a lot of calls in the literature. So Mazzucato in the Value of Everything, she said, we need to have this a more dynamic theory of public value, but didn't really go into detail about what that would look like. But this really interested me as a public servant, because I think increasingly, we need to be looking at not just the value that is created in terms of the financial metrics, which was very much what green banks sort of measured their success by. They looked at how much capital had been committed, was one of their core kind of metrics, the overall quantum of finance that had gone out the door. They looked at the leverage ratio, so how many dollars of private sector finance were they mobilizing for every investment that they made. And then they also looked at the emissions reductions and the benefits. But that then leaves a very significant component of value that's being created from their investments and this public value creation. And so this chart attempts to actually, break some of that down at different levels, thinking about the societal benefits of green banks and how they assist, countries to meet their NDC and Paris Agreement goals, and the sort of private value that's created through that, but then also the public value creation through the reduced emissions and climate change and sustainability benefits that come with that. And then so we did this at these three levels, and I think what I found really interesting was that so much of the value that green banks are creating is currently not being captured at present. And that then, becomes a very interesting question for policymakers about how do we actually capture that value in the transition, and what forms of new investment governance and evaluation do we need in this transition. And I think by not capturing this value, we are actually devaluing public institutions. And I think that's something, that we've definitely seen in, over the past sort of 15, 20 years in Australia, where there's been sort of a decline in trust in public institutions. And I think that's probably somewhat reflected in the US as well. And I'd be very interested to hear people's thoughts on that in the discussion. But I think this exercise to me, where really showed the need to think about these types of value and value creation and value capture more broadly in the transition. And so, the conclusions of the paper are that, that green banks are a significant new form of hybrid organization to emerge in the transition, that they're creating a range of public and private value, and that the value is not being fully captured at present. And so I will leave it there and open it up to questions, to comments, and yeah, very much looking forward to this discussion.
Excellent. Thank you, Chell. That was a wonderful talk and an incredibly insightful presentation. As you mentioned, I'm excited to open the floor for questions, and it looks like we already have a couple. Folks, feel free to continue to type your questions into the chat. Chell, I wonder if we can start with this from Chris. Chris says, I am interested in the quantum of the funds under management by green banks. The current net zero financing gap is at least 5 times, and the magnitude of that capital allocation deficit is circa $4 trillion plus or minus per year. Is it plausible that green banks could scale globally to bridge, say, 20% of the deficit, and could that catalyze the required levels of private capital?
So it's a really interesting question. It's a great question. And I think there definitely is a much, much bigger role for green banks to play. And so that's something that has been a focus of a couple of the other papers in my PhD. I'm sort of thinking about how the green bank model can be adapted for the Indo-Pacific region. And I'm focusing particularly on Indonesia because it's one of Australia's closest neighbours. It's the 4th largest emitter. And it's very much sort of scaling up its private sector financing. And then also Pacific Island states, which are kind of the complete opposite. They have some of the most vulnerable states to climate change, tiny mitigation, but very huge kind of resilience needs. And I think it's really interesting to think about the role that green banks could potentially play in adaptation financing. And so I think if you think about every country in the world having a green bank and then potentially having some subnational green banks or county green banks to help accelerate those gaps, you could, definitely start scaling up significantly. But the key issue that we face at the moment all around the world is the skills gaps that are needed. So we absolutely need to accelerate the training of people who can make these types of investments, because the existing green banks are already kind of finding it challenging to find people to bring in to make these kinds of deals that have the expertise to de-risk the investments, to create the investment pipeline, build the projects out, and to work with experts and others in government to do that. And then we also face a huge issue with having the actual people on the ground to, build the large scale solar, systems that we're putting in, put in all the EV infrastructure to string the poles and wires for transmission. And so, I started my thesis in this research really thinking that this was an investment, I started thinking that the net zero transition had really moved from being a technology challenge to being an investment challenge. And I've now changed that to think that we're no longer in an investment challenge, really. I mean, we are to some degree, but what we're largely moving into now is a skills challenge. And I think that's going to be the critical component in how successfully we could, scale up green banks, is how well we can actually sort of get people trained to make those investments at both sides of the sort of scale. Yeah, but I think they're a very exciting option.
That's a really insightful point about skills training. And I feel like that's not something that most folks tend to think about when they think about financing the energy transition. Maybe on that note, I myself have a question about how green banks think about striking that balance between promoting like higher risk projects, essential probably for net zero, but also ensuring financial prudence, especially considering like the urgency of the Paris Agreement. And I'm wondering if you have any thoughts on what are some of the potential political, economic, or climate risks and opportunities of a slower transition.
That's such a great question, Claire. And I think it was one of the pointiest issues in all of the interviews that I did with the green bankers, because a lot of them in Australia, particularly, the CEFC has come under fire because in the 10 years it's been in operation, it's only had one project that has not succeeded. And even that project, the CEFC got the finance back because they had structured the deal in a way that they were able to take it back before that company became insolvent. And so that has led to some people sort of questioning whether they have the right risk appetite. And I mean, my personal view on that is that the CEFC was correct to take a cautious approach because, and I'm not sure how closely your audience follows Australian climate politics, but back in 2013, when the CEFC was mandated, it was a complementary measure for our carbon price. We had a change of government and that carbon price was repealed. And there were attempts to repeal the CEFC as well. And we actually have your former Vice President Al Gore to thank for the fact that the CEFC is still around, because in a very strange twist of fate, the Australian Senate was controlled by none other than a mining billionaire. But Al Gore came over and convinced this gentleman that had the deciding vote to save the CEFC. And so I think many Australians are very grateful to him for doing that. But I think, had the CEFC taken on a bigger risk appetite, there would have been a lot more political kind of calls for it to be repealed. And so I think its risk appetite is now increasing because the ambition of its targets are increasing, and also the urgency, as you mentioned, of the physical kind of impacts of climate change, are starting to accelerate. And so we actually need to take a broader approach to risk. And I think the UN Secretary General kind of characterized it best when he launched the IPCC sort of special policy SPM report, where he was like, we need everything everywhere all at once. We need to be, kind of doing the highest things, the lowest things. And we actually need, I think, to do what David Victor from UCLA advocates for, which is this policy experimentation where, we're trying lots of different things and we're evaluating in a dynamic way to see what's working and what's not. The obvious challenge with that is that that's very confronting for most policymakers who have not traditionally done that. But I think that's exactly why we need hybrid organizations like green banks that can kind of bring in some more entrepreneurial kind of private sector people who are willing to take on, to have a bit more of that risk. Yeah.
Super, thank you. We have another question from Paul. Paul says, thank you for the great talk. Is there data on why politicians created these fairly independent green banks in the first place for decarbonization, as opposed to using pre-existing quote unquote traditional government agencies? Was the green bank's ability to leverage unconventional funding arrangements the primary reason?
I think it was recognition that there were barriers to investment that could not be solved by other policy instruments like carbon pricing or other measures, so that there were these barriers that really needed to be addressed in a more systemic way by an institution that had significant technical expertise in the sort of projects that they were financing. And I think, so I think that it was really, there's not a lot of data. Sorry, I'm just looking at the question and sort of thinking through. There is a great, another great paper that Getty's, who did that paper on the barriers to investment, she did do another great paper about the sort of political environment around the creation of the CEFC and the UK Green Investment Bank. So that, has a lot of great detail about the kind of policy enabling environments in those two cases. But I think it largely comes down to the fact that existing government departments couldn't make the type of investments that needed to be made. And so they needed to sort of create these sort of entities slightly outside government that would fix these sort of failures that weren't going to be fixed through other market measures. Yeah.
Excellent, thank you. I'm a little bit curious, Chell. What do you think are some of the potential trade-offs that could exist between a green bank's goals? I'm thinking about potential value creation or goals like demonstrating the performance of the clean energy assets to the private sector, or supplying as much capital as possible to the market, or maintaining and growing the bank's capital, and some goals like accelerating the clean energy development, but in underserved sectors. Like, how do you think about those trade-offs?
So I think this is something that the green bankers I spoke to spent so much time thinking about. And so, and it's been interesting as the organizations have evolved, they've actually started to recognize that those trade-offs much more. And so the New York Green Bank, for example, has changed its investment mandate, I think in sort of the past 12 months, so that they now explicitly state that serving disadvantaged communities is a core part of their investment mandate, which wasn't initially. And so I think, the trade-offs between, these deals that provide the kind of capital investment volume versus the deals that provide those broader public goods are something that they think about a lot, and keep them up at night. But it's not something that necessarily comes through in the financial reporting. And that's what, that's been one of the most interesting things to come out of this, I think, is that, a lot of the green bankers I spoke to, at least, they're people that, could be earning twice, 3 times the salary in the private sector, but they have this deep commitment to the public goods. And so that's why these early green banks have actually been able to sort of deliver so heavily in those areas. And so I think that's something, I think it's very, very positive to show that green banks are able to manage those priorities. But I think it's so critical that we've developed forms of evaluation that actually capture those benefits more effectively, so that new institutions, with perhaps less experienced staff, are actually thinking about those trade-offs in a more systematic way and actually reporting them in a more systematic way.
Yeah, absolutely. I do feel like impact measurement is really significant. We have another question from Martin. Martin says, very interesting research. Could you give us more examples of what investments were made by these green banks?
Yeah, sure. Well, one of, I think, the most interesting sort of investments that has been made by the New York Green Bank was a really fascinating company called Agbotic. That was they were sort of robotic greenhouses that used very sort of sustainable agricultural practices to grow vegetables and herbs and fruit for New York restaurants. And so this very interesting technology that the New York Green Bank provided funding for initially in upstate New York. But when COVID hit and the pandemic sort of caused lockdowns everywhere, they pivoted to providing food to insecure sort of parts of upstate New York. And so the New York Green Bank gave them a second kind of loan to do this during that time. And then once, the lockdowns were over, they sort of pivoted back to their traditional kind of, supply. And I think it's a really great example of again, the public value that can come from these investments, and that the kind of flexibility happens. But I would say overwhelmingly, most of the investments are in clean energy technology. So we're looking at, large scale solar, we're looking at offshore wind, which is something that New York's just had, the auctions recently. And I know the New York Green Bank has been sort of, heavily sort of involved in those processes. And yeah, so I think the clean energy technology examples are probably the best, and that's sort of the key part of the portfolios. But all of the organizations are really branching out into different sectors like transport, heavy industry, agriculture. There was a really cool example in Australia where they're investing in this technology that actually calculates emissions at farm level and allows farmers to calculate quite simply the emissions for their crops and farms and things. And that would be a big game changer for Australia, which has quite a big agricultural sector, and also New Zealand, lots of application in the US. So yeah, lots of opportunities.
Excellent. We'll take one last question from Pradeep. Pradeep asks, does green banks finance large CapEx projects such as CCUS? And how green banks mitigate the risks associated with the commercial deployment of new technologies?
So they do definitely fund large CapEx products, but none of them have funded CCUS to date. So it's more sort of renewables. And then in terms of mitigating the risks associated with commercial deployment, they have, very strict due diligence in terms of understanding the technologies, in making sure that the co-financiers are credible and, doing all of their due diligence around the financing. So, they do everything that a normal commercial bank would do, but then they also have this sort of additional sort of technical expertise around understanding those emerging market segments more. And they have a significant advantage because they have access to government policymakers. And I think one of the managers at the New York Green Bank said to me, that it's wonderful because if there's a new technology that is emerging that we don't know much about, there's probably a whole team at NYSERDA that does know all about it. And so they really leverage that, that expertise within government in a way that private sector organizations can't.
Excellent. That's really insightful. Well, as we approach the top of the hour, reflecting on this really engaging and thoughtful discussion, Chell, I'm wondering if you have any last thoughts for us.
Only to say that, I think it's, so exciting to see the US National Green Bank funding sort of round, coming to a close shortly, and that, the US has done so much excellent work around green banks at subnational levels. We need to work together, Australia, the US, New Zealand, all of these existing countries with expertise to really help countries around the world to develop these institutions as well. I think there's an enormous opportunity for all of us to harness that expertise in a really meaningful way to accelerate the transition. And thank you so much for your very thoughtful questions, Claire. I really do appreciate it.
Great. Thank you so much to your, sorry for the awkward silence. A little trouble turning my camera back on. Thank you so much to both of you for this talk. Chell, what a really great talk. And thank you so much for sharing your work on such an interesting topic. And Claire, thank you so much for moderating a really interesting and insightful discussion. Really appreciate you both being here. So Chell, thank you so much. And before we wrap up, I just want to let everyone know that we do have one more new energy talk coming up for the fall season, which will be on November 8th. It's with Camilla Stubenberg, who's a PhD student at Cornell University. And he'll be talking about, does grid collapse accelerate the energy transition? Lessons from Lebanon's electricity crisis. So he's done quite a lot of work in Lebanon on this topic. And so we're really excited to have Camilla here with us on November 8th. But again, Chell, thank you so much for being here. All the way from Australia, not similar time zones. We really appreciate you sharing your really interesting work with us today. And thank you so much, Claire, for your moderation. And we hope to see you all again. Thank you so much.